Blog Talk Radio.
To all of our friends overseas and all of our peers in the credit and finance management industry, welcome once again to Business Credit Radio. We're on blogtalkradio.com. I am your host, Phil Philbin. Business Credit Radio is the voice for credit and finance professionals worldwide. Today I want to introduce our special guest, Mr. Andre Casterman. Business Credit Radio is honored to welcome Mr. Andre Casterman. He's calling us from Brussels, Belgium, as our featured speaker. Andre heads up SWIFT's strategy and business development in the corporate and trade markets. His responsibilities cover payments and cash management, treasury, trade and supply chain finance. Andre is also a member of the Executive Committee of the Banking Commission of the International Chamber of Commerce, where he co-chairs the Bank Payment Obligation Project. Andre was previously Director of SWIFT France and SWIFT's global relationship with BNP Paribas, SWIFT's fourth largest customer. From 2001 to 2005, Andre left SWIFT's products and began development activities in low-value payments and rolled out Swift Net File Act in that market. Since then, Swift Net File Act has widely adopted by banks to exchange payment and cash management files. From 1997 to 2001, Andre contributed to the design and commercialization of Swift's new IP-based messaging portfolio, SwiftNet, which has now become the foundation of all Swift activities. Andre joined Swift in 1991 in information systems, where he contributed to numerous IT projects, including the rollout of SAP in support of Swift's order-to-cash process. Andre has a master's in management and a master's in computer science from, oh boy, I hope I'm pronouncing this right, Andre, and I'm sure I won't, Verge Université Brussels, and a degree in applied economics from ICHEC Brussels. Andre speaks fluent French, Dutch, and English. We are really honored to have Andre here today. Our discussion is going to be the bank payment option. Welcome, Andre.
Thank you, Tony. I'm glad to be with you today. It's my first time on radio, so you know.
Well, we're happy to have you on the radio, and it's the first time, so it's an honor for us to have you here, Andre. And I've done a lot of reading on this, and still there's a lot of questions that I have, and I'll start you off with the first question. So I can have it clear in my mind and the listeners can have it clear in their mind. What exactly is supply chain finance, if you could kind of bring us in on that?
So supply chain finance, as it is offered by banks today to the corporate market, enables basically to extend early payments to suppliers on using the working capital of the bank rather than the working capital of the buyer, the funding of the bank rather than the working capital of the buyer. It works based on electronic flows, and this is quite interesting because financing has usually been based on paper flows, and it is working on the basis of an invoice being approved by a buyer, usually a large buyer, and that is triggering, it's a key decision to accept an invoice, of course, for the buyer. It's triggering an electronic flow to the bank, the buyer's bank, and the buyer's bank will then propose early payments at a discount to the suppliers. So it's one financial intermediary in the buyer-supplier relationship, enabling the suppliers to get cash earlier. That's today's definition, and we're going to see during our talks today how we want to extend that to additional services.
So, if I'm correct, and I read this off the white paper, it says, faced with the increasing pressure to meet short-term liquidity needs, companies are looking inward for ways to release trapped cash from operations. So, can you kind of explain what trapped cash is and why it's so important that it be done this way?
Yes, cash trapped means in the supply chain means that basically the suppliers are basically able to have receivables that they could discount and get faster cash. That comes at a cost. So getting a payment earlier than the invoice due date comes at a cost, but that funding cost can actually be quite attractive for the supplier, because that funding cost is based on the buyer's credit standing. And when we are in a scenario where the buyer is a large company with a good credit standing and the supplier is an SME, the funding cost of those supply chain finance programs are quite attractive to those SMEs. And we have seen it being rolled out by many large buyers in the market, and not only being taken advantage of by SMEs, but also by larger corporations. So releasing the cash trapped means that the supplier knows it's going to get the money as from the invoice due date, if the buyer pays on time. And releasing that cash trapped in the supply chain means that with a few human decisions, such as approving an invoice and electronic flows, the supplier will be able to get its cash much earlier.
How much would the discounted price be, Andre, would you guesstimate? And is there any recourse in the event something goes wrong in the transaction?
So in the typical programs, supply chain finance programs that we see today and that many banks have rolled out, there is indeed a financial benefit for the suppliers, because the risks for the banks are low. We are in those programs at the very end of the supply chain. That means when the buyer has approved the invoice and payment must be made, so that's really the end compared to the start, which is at purchase order level. So the risks for the financial intermediary is very low, because the buyer has approved the invoice, and the recourse is very limited. And the financial gain for the supplier is, because of the low risk, very attractive.
Would you like to hear more? This is Phil Philbin, the radio talk show host on Business Credit Radio. This full version is available at www.blogtalkradio.com, or you can go to our website at ccma-llc.com. I'm Phil Philbin for Business Credit Radio, and we'll leave the phone lines open for you.